So we are certain that silver is in massive demand in India right now after the tax increases in gold.
Can you, while we're at it here, take a little closer look at the silver ETF, SLV, please?
Yes, Shane, you know you bring up silver at some point. SLV has the same issues as GLD, which is we also evidenced back in March 2020, but SLV's ETF backdoor was once again exposed as recently as February 2021, when SLV custodian BlackRock announced it would not go to market to buy physical silver to match a massive influx of silver orders, which would have driven the silver price tens of dollars higher overnight. So for the purpose of discerning the difference between GLD and SLV, the algorithm inputs have on silver versus gold is that silver is not Basel III compliant. However, silver is also a deliverable foreign exchange cross. So joined at the hip to gold with the ratio trade, the visible, actionable cross that you can measure it against. And when the gold-silver ratio is driven to extremes, as is the case now, it'll be arbitraged by market-making insiders exposed to delivery obligations, forcing a pushback against otherwise price-controlling COMEX-centric algos. So we are certain that silver is in massive demand in India right now after the tax increases in gold. Yes, smuggling has increased from the 30 tons a month to what we believe is closer to 100 tons right now to fulfill the oil trade, the Russia oil discount trade.
All right. Now, Andrew, there's been some recent questions also from the community regarding Ukraine selling its physical gold holdings. Do you have any insights on this area?
Yeah, Shane, I think the real question is, are Ukraine gold sales rehypothecated? Now, following Peter Schiff, and it was summed up in Zero Hedge, I'm sure it's still on Zero Hedge now, Peter Schiff highlighted the discrepancies surrounding Ukraine's gold sales activity. So we went to our own well-connected liquidity providers to dig in a little deeper, following the Thursday 21st lows to assess if any physical had indeed appeared for sale into such a large downside gap close attempt. Now, given the lack of physical coming for sale into the recent backwardation conditions, already suggests that the so-called Ukraine gold hoard has indeed been rehypothecated and sold as part of the official G7 mandate to attack Russian gold which was adopted by the EU last Thursday. Now, just note the timing of this officially driven paper market-driven selling, along with the freezing of Sberbank's assets. That's when the low was made. And while we still need to fully verify that these sales are leveraged COMEX-centric paper sales, really probably backed up by what is estimated to be maybe a tenth of physical margining for this sale, the fact that none of our liquidity providers have evidenced any such large physical supply appearing in the wholesale market for sale, it very much suggests that officials have been leveraging these sales. This also jives with a degree of expanding futures backwardations extending to as large as $3.65 per ounce for gold on last Thursday into the lows. If there was any size of physical coming to market, these backwardated spreads would be eliminated, or indeed futures would be in contango, i.e. trading where they should be as a futures contract, reflecting carry costs, etc., at a higher price. And this plays into the ill thought through G7 sanction attempts to target gold and cap Russian oil prices. They're both going to backfire. Selling paper gold to depreciate gold is going to result in a major backfire on the G7 countries backing this risky, unbacked gold bet.
Now, Andrew, as many of our community members know, that you've been way ahead of the market, telling us that under the radar, as part of their mandate to force agent banks holding counterparty risk to comply with the Basel III and the NSFR rules, the BIS has been stealthily unwinding its lease and its swap positions over the last few months. Now, the latest BIS report really confirms what you've been reporting for months now. Are you still seeing this right now?
Yes, Shane, we are. And back in 1998, Frank Veneraso projected that 25 to 50% of all reported central bank reserves were out on lease. Now, back then, these were physical leases. However, since then, global exchanges have sprung up and have evidenced mispriced leased bullion outflowing on a one-way trip. This activity essentially reopened the gold window, which is one of the main reasons the BIS stepped in to stem the central bank to central bank physical and paper ETF outflows by introducing Basel III NSFR standards in January. Notably, concurrent with Basel III NSFR legislation, the closing of BIS swaps and leases that we've been reporting as accelerating over the last few months is now becoming evident. Gatter's consultant, Robert Lambourne, he does an excellent analysis on this, which now verifies exactly what we've been reporting and can be found on the Gatter website under the heading Basel III BIS Gold Swaps. The BIS is ramping up their efforts to square up long-standing leases and swaps. That's clear. And a caveat here is that not a single physical ounce has exited the BIS gold site account since 2015. The swap and lease liabilities were laid on the balance sheet of the agent bullion banks who have gold accounts with the Bank of England. And while these efforts accelerate, any residual leases or swaps can be cash settled into a gold revaluation price reset. However, while the BIS have been busy covering these swaps, stepping up, laying these liabilities onto the COMEX specs into the rigged March 4th, this is 4 months, since March, we've had a 4-month price decline, which they've been actively using to dump these liabilities onto the speculators who are going to get rinsed. And once these limits are reached, it looks very close here, a final squaring of cash settlement will ultimately substantially raise the price of gold. Now, while derivative gold will be cash settled with a keystroke entry, it's important to know that we think the CME LBMA alliance will allow COMEX gold to rise to protect this massive cash cow. It's the tricked in naked short speculators who will lose their entire margin positions overnight, naked short and set into an overnight revaluation. Now, it could be unlimited liability here, not just what you bet, but unlimited liability if you go bid only and there's nobody there to sell. And we have lots of first-hand evidence that insiders are already building up very large physical positions. And it will also be long and strong foreign exchange gold into a black swan event, or in the case of a planned price reset, whichever happens first. One of these things is going to happen. The only question is, and I know we always end up with leave on this note, how much physical gold and silver do you own, guys?